Warriors of price action and guardians of fundamentals, welcome to Retail Recon. On today's episode, we're tackling one of the most practical and accessible multi-leg option strategies. The long vertical call spread, also referred to as a bull call spread and long call spread. This is a bullish setup that lets you profit from an underlying moving higher, but with a lower cost and defined maximum risk compared to buying a naked call option. The objective is simple. Understand exactly how this strategy works, when to deploy it, how to calculate risk-reward, and how to avoid the traps. Before we continue, make sure you completely understand the options basics, especially what does it mean to be a buyer or a seller of an option. The fundamental knowledge is critical if you want to engage in any type of option trading, particularly when entering into multi-leg strategies. With that being said, let's move on. Think of a long vertical call spread as a precision-guided missile for bullish setups. Instead of firing a single, usually expensive naked call option, you're launching two coordinated call options working together. You buy a lower strike call and simultaneously sell a higher strike call against the same expiration date. The net result is a debit spread where you pay less upfront than a single call, get defined risk on both ends, and create a high probability bullish bet that profits from moderate upside moves. The upside of this play is that you limit your risk, but the downside is you limit your potential profit as well. The vertical part refers to the fact that both calls have the same expiration date but different strike prices, creating a vertical line on the options chain. This strategy shines when you have a moderately bullish outlook. You expect the stock to rise, but not explode 20% up where you'd want a straight single call option. Generally, you will have a defined upside target, how much the stock will move higher. You will enter this play with the stock price being around or above your long call, the one you bought, and below your short call, the one you sold. You are aiming that at expiration, the price will be at or above your short call, but not so high above to make you regret that you didn't buy the call outright. Well, even if that happens, just know the reality of trading is that the trade always works best when you exit. It will happen on many occasions, so be happy you got the win and move on. Moving on to the key point number 1. Unlike outright calls, where your maximum loss equals the full premium paid, the vertical call spread's maximum loss is limited to the net debit you pay to enter the trade. Your maximum profit is also capped at the difference between strikes minus the net debit. This creates perfect symmetry for learning multi-leg strategies without unlimited risk exposure. Why this works? As a call buyer, you get the right to buy at the strike, in this case the lower price. As a call seller, you have the obligation to deliver at the strike, in this case the higher price. If the price moves up, your long call will have value. If the price moves down, your short call will have value. One offsets the other and hence offering defined profit or loss regardless which way the price moves. Just to clarify, when the price moves down, the short call has value in terms of the premium you received. From the perspective of a buyer of the call you sold, that option is worthless. How long vertical call spreads work? Let us walk through the mechanics step by step with a complete example. Imagine ABC is currently trading at $4.20 per share and you have a bullish outlook because the stock just broke above key resistance. You expect ABC to reach $4.30 in the next 30 days, but doubt it will rocket to $4.60. Step 1. Select your strikes. You buy the $4.20 strike call option, expiring 30 days out for $4.20 premium. Simultaneously, you sell the $4.30 strike call option, same expiration for $2.10 premium. The first one is of course debit and the second one credit. Step 2. Calculate net debit. $4.20 debit minus $2.10 credit equals $2.10 net cost to enter. This $2.10 is your maximum possible loss if ABC stays below $4.20 at expiration. Step 3. Determine max profit. Strike difference, in this case $4.30 minus $4.20 equals 10, times 100 shares equals 1000 potential minus 210 net debit that you paid for the spread equals 790 maximum profit. Step 4, break-even calculation, lower strike plus net debit. In this case, 420 plus 2.10 equals 422.10. ABC must reach $422.10 just to get your money back. Let's now look at 3 scenarios at expiration. ABC is at 415, below break-even. Both calls expire worthless. Your loss is limited to the net debit paid, in this case, 210, which is the difference between paid and received premium. ABC at 425. Your 420 call is now worth $5 or $500, and your 430 call is worthless. Net, that's 500 minus 210 debit equals 290 profit. If this is a bit confusing, remember to always value the options from the buyer's perspective. Your long option, the one you bought, gains value as the price goes up. The short option has zero value for the buyer as he can buy cheaper on the market than exercising his option, hence worthless. So when calculating the value of the spread, just remember if the price is below the short option strike, the short leg is worthless. In those cases, your profit is price minus lower strike minus net debit. ABC above 430, you're at max profit. Let's use 435 for calculation. Your 420 call is now worth 15 or 1,500, while your short call at 430 is now at a loss of 500. Why? Because it is in the money, has value now, and it would cost you 500 to buy it back. The net difference is now 1,000, and subtract the debit you paid for the spread, 210, and that brings you to 790, your max profit. Key takeaways from this example: if you would have bought an outright 420 call, it would have cost you 420, which is double what you have paid for the spread. But on the other hand, you have kept your upside. For that reason, if you have a strong bullish conviction and you are convinced there is a lot of room to run, just buy the call outright. You could potentially close or roll your short call before expiration, but make sure your thesis is still working and the math checks out. And remember, the closer you are to the expiration date, the bigger role gamma plays. More about that in future episodes. Why traders use long vertical call spreads? Vertical call spreads solve 3 massive problems with straight calls for traders. First, cost efficiency. Spreads usually cost less than straight out long calls. Second, defined risk. Your maximum loss is limited to the net debit paid and it is lower compared to having an outright call. Third, higher probability. The short call leg lowers the break-even point compared to a straight long call only. It is perfect for moderate bull setups. You expect a move higher during certain periods or events such as post-earnings drifts or sector rotations. Common beginner mistakes: wrong wing selection. Short strike too close, which results in tiny max profit. Second, ignoring theta. Selecting calls too close to expiration. Third, no exit plan. Hold losers until they reach max loss. Have rules of engagement in place, especially what is your hard exit target. Fourth, earnings FOMO. IV crush trap, skip catalyst events, unless of course you decide to have some fun and gamble on things like earnings. Just keep in mind to gamble with what you are prepared to lose. Fifth, oversizing. Don't risk more than 2 to 3% on any given setup. And with that, we wrap up this episode. On our next episode, we will look at the opposite call setup and debrief short vertical call spread, referred to also as the bear call spread. If you found value in this episode, be sure to lock in your support by liking, subscribing, and following our movement. Thanks for standing watch with me today, and until next time, trade smart, risk sharp, and stay on target.